Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. Real estate right now is something that lots of people are giving a big question about. Interest rates going up, but prices look like they may be coming down. And a gentleman that I've met recently wrote a really interesting post about, and then had a webinar about investing during a recession, which I wanted to reach out to him and understand a little bit about what his strategy is and what he thinks the issues are. My guest tonight is the individual I'm mentioning, Simeon Papailias. He is a real estate broker. He's an entrepreneur. He runs a company called Rec Canada. He specializes in real estate, but also real estate from an investor orientation. And he thinks that we should be thinking a lot about investing to win during a recession. Simeon, welcome to the show, sir. How are you?
Brian, thank you for having me, my friend. I'm well, and I hope this show finds everybody well.
Appreciate that. So can you invest and win during a recession?
Since the beginning of time, my friend, it's during these times that most investors will find a way to separate themselves from the pack. It's definitely not during sunny skies that opportunities find themselves to be spectacular. It's when the kind of that playing field is well groomed that everybody can run a bit faster. It's when we find ourselves in unique circumstances where everybody's different value proposition can create different opportunities and bigger opportunities for that matter.
You know, it's interesting because some of the biggest family wealths that have ever been built were built during either the Depression or big recessions or wars or times of strife. And so, you know, when times get tough, the tough get going is sort of the little adage that people use. But a lot of people don't know how you actually do it. So if you're right and I'm right that tough times make for opportunities, how do you go about doing it?
Yeah, and first and foremost, this is not, I don't ever want to use any media outlet or your show for that matter to convince anyone whether it's a good time to invest or not. Investing is such a personal engagement because we're talking about any one person's hard-earned dollars going to work for betterment. That's what investing, that's the goal, the actual goal of investing. You're going to take your dollars and you hope and trust in whatever process you choose to grow that wealth outside the ability of your everyday life. So taking that into account and the responsibility that bears, I just want to ensure that people who listen to the content that we're putting out there today understand that any advice, any concept that we speak of right now is extremely individual to each person. And what they should try and take out of it is their ability to take action if they are capable and able to. Because during a recession, just like you can win investing, you can just as well lose.
Lose, no question.
And that's where education, and that's where my life's work comes in, is where I truly try and strive to create confidence with knowledge. So if you know how to interpret data and if you know your circumstances well, you can make good decisions, very good decisions.
Okay, I agree with that, and I think that your caution at the top is very helpful and well deserved, and so thank you for that. However, during good economic times, you know, it is a little bit easier, I think, to make money. Day trading or you know, investing in cryptocurrency or just buying real estate and flipping it, because you get the benefit of a positive growth pattern to whatever it is that you're investing. But it's during that time periods, like a recession, when the markets are down, that really you probably need more knowledge, as you've well stated, but those big opportunities, if you find those good opportunities, exist. So tell me again, how do you think people should go about thinking about this opportunity?
Absolutely. So real estate as an asset class it's the only asset class on earth, or we'll just focus on our beautiful little environment in Canada is the only asset that can be leveraged. And we're talking about a mortgage. So if the purchase price is $500,000, in order for you to purchase any said property, any piece of real property, you typically, as an investor, have to put down 20%, but you gain the advantage of an entire appreciating asset. In stocks and bonds, you want to buy $100,000 worth of stock in Microsoft, you do just that. Here, with $100,000, you can buy an asset that's worth $500,000, service its debt, and gain from its trajectory, whether it's upwards or downwards. And that's exactly what we're going to dissect today. How that happens, why it happens,
So
and how
what
you
you're
can
saying is
win
that
on
the
that
key to
value.
success in real estate investing is the use of leverage. Is that correct?
It is absolutely the biggest fundamental of it. It's not the only one, but it's by far the biggest. Those who know how to use debt properly make the absolute biggest gains.
Okay, but you can margin a stock security.
You can margin a stock security, but the actual safety and or speculation of that investment has a very different profile. So
And why is that?
because a stock is not a commodity. Housing is a commodity, real estate, whatever. So everything we see when we open our eyes and we walk out of our home is real estate, whether it's owned by the city and it's a park, whether it's a school, whether it's industrial, whether it's a shopping mall or plaza. Somebody owns everything that we see, everything. Unlike a stock where any event can make its markets collapse or trigger its appreciation, the profile of housing has a very different risk profile. Housing is required and necessary at all turns in life. And if you understand the forces of supply and demand in any given micro market, meaning that I don't speak to GTA as a market because the GTA has 500 markets inside it. If Brian Crombie was to invest tomorrow morning, we would have to decide where. And that's where the analysis and the microclimate of that environment comes in. Is this a neighborhood that you're trying to invest in on an upwards or downward trajectory? Is there jobs? Is there factors coming in? A new transit line, a new LRT? All the things that go into a decision that are going to impact precisely what happens to your real estate. Now, going back to the question from, taking margin on stocks or calling or putting or whatever the case may be, you're talking on very simple market forces that can be changed overnight by forces that you don't control. Meaning that a fire at a distillery in Saudi Arabia can throw off your entire investment if there's a lot of fuel involved in transportation or logistics. A strike in China can tumble your stock overnight by 80%. Where nothing can impact housing like that other than massive world events. And these massive world events that we speak of, pandemic, rising interest rates, inflation, wars in Ukraine and Russia, all these world events are going to impact everything else first until it comes down to housing. So you still have time and the luxury with housing to adjust your position should you feel that it's going to have an impact and or affect your portfolio. It's always the last one to get hurt. And by that time, everything else is hurt as well. And that's part of the ebbs and flows. But as a risk profile, it is much more stable.
So for a lot of these reasons, as you've identified, real estate has a what banks, I guess, would see as a lower risk profile, and so therefore they are willing to leverage it to a greater degree. And I would argue the other thing is that they're leveraging it at lower interest rates, which is beneficial, with longer amortizations, which is beneficial, with mortgages that are against that asset class. Versus, against a margin or other kinds of loans, which have a security against it that may be, while there's still recourse, may be less recourse in nature to the individual, particularly in the commercial world. And I think finally that they're a little bit less quick in responding to negative results. And so I guess what your comment is that the banks will maybe it's because real estate responds to external events more slowly, but the banks that are financing real estate, I think, respond a little bit more slowly because the market value isn't determined on a second by second basis like it is in a market.
And that's just it. So I don't think it's just the fact like people respond more. It's a simply more resilient asset class, no matter what, because the impact of it, it's the last guard. If you think of risk profile from an organic grassroots level, if tomorrow morning I were to lose my job, if I got injured, if I got sick, any savings I have, I'm going to do everything in my power to protect my home to the last stand. What does that mean? I will cut off cars. I will buy cheaper food. I will wear the same clothes. I will do everything, but I will pay my rent. I will pay my mortgage to the bitter end. So if human nature is to protect their shelter, their home, their one asset to the bitter end, that is human nature. That's not a coincidence. It's not like I like the bank more than I like my auto provider. It's a matter of what I need in what order. That creates the environment of real estate being the most secure, resilient, and stable asset class because it's something we actually need for ourselves and our family.
We're chatting tonight with Simeon Papailias. He is the founder of, it's called REC Canada. Is that correct?
REC Canada, the Real Estate Center, but it's REC Canada.
Real Estate Center, REC Canada, which is a brokerage investment organization here in Toronto. He specializes in, I guess, the GTA, but also in investment properties. We're talking about investing to win in real estate during a recession. How do you do it? We're going to be back in just 2 minutes, everybody. Stay with us. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Simeon Papailias, REC Canada, REC Canada, real estate company in Canada, talking about investing to win in real estate during a recession. Simeon, lots of people are worried right now about the real estate market. Interest rates are up. I don't know whether prices are down or not. The statistics I see say real estate prices are down in sort of suburban markets, Brantford, Brampton, London, etc. But people have different points of view about whether they're down or flat in the Toronto area. But volumes are way down, and so people are thinking it's going to come down. In that kind of environment, why are you telling us that we should be considering investing?
That's a greit question. It's a very common question, and we can definitely break this thing down to bite-sized pieces. So first and foremost, I'm not a silly optimist about anything. What I want to go over and what I want everybody to understand are the facts of how we got here. Where the average price is well over $1 million, where affordability has eroded to the point where I was just part of an article talking about the millennial and Generation Z sentiment around housing, and it's very sad to be a part of a study like that because I saw the numbers first, and 70% of Gen Zers, the kids, teenagers into their mid-20s, 70% do not believe they're going to achieve home ownership in their lifetime. And these aren't silly kids running around getting high. These are kids in university. These are kids who take their life seriously, who agreed to sit down and take part of a study. That's sad.
It's incredibly sad when, number one, it's sad on its own, but sad when you think home ownership generally in the Canadian population is over 70%. So the vast majority of Canadians, not of that Gen Z generation, actually do pride themselves in owning a home.
And that is correct. And this is where we will get to the opportunity of investing during a recession, but to understand the landscape and the environment that we are in today, we have to understand that. Let's go back to 2017. Let's look at the last 5 years. 2017, we had a blazing hot market to the point where the Wynne government at the time implemented what was called the Ontario Fair Housing Plan, which was a complete mockery to the housing market. It was silly. It was a bunch of Band-Aids layered on top simply for politicians to be able to do what they do and try to provide a solution, but it wasn't well thought out. It froze the market for 6 months, and within 8 months, the prices of homes in Ontario were higher than what they were at the peak of April 2017. Fast forward to March 2020, market's doing its thing, the world is doing its thing. We all go into this crazy pandemic that we all know about. Everybody panics, the whole world, including ourselves. What do we do? How are we going to go through this? And the government looks at monetary easing policies in order to continue the world to work. So while logistical chains, supply chains, all employment, everybody's at home, the world goes on like as if nothing happened, because they start releasing money from the banks in forms of loans, mortgages, and everything else at the deepest discounts with the absolute lowest cuts in interest rates in human history in this very country. We get through the pandemic not without seeing a 60% increase in housing costs.
60%?
60%. So a home that was 400,000 is now 800,000. 550,000, 725,000. Pick any market.
Driven by low interest rates is what you're saying.
Driven by free money. I could borrow $500,000 at 1%. It's actually, they're paying me to take the money.
Because they were worried about a deflationary environment. They were worried about the economy coming to a screeching halt. And so what you're saying is that they flooded the market with cheap money.
They flooded the market with cheap money. Not only did they flood the market with cheap money from a structural mortgage and lending perspective, Ottawa started printing money to feed its entire country in the tune of $1,000, $2,000, $40,000 for businesses. They printed money and put money out there to help its people. Whether I agree or disagree with how that went down is irrelevant. The facts of how we got here are true. So we create an environment of flooding the street with money, flooding investors, such as myself. During the pandemic, I almost doubled my portfolio. Me personally. I know hundreds or thousands of my clients who doubled their portfolio during the pandemic. When the pandemic ended, which again, I have way too many personal views for how this was handled, which are completely irrelevant at this point. When they decided that overnight where the pandemic was over and nobody's tracking anything after 2.5 years of destroying businesses and people and everything else, not to say that I don't believe in the lockdown, because I do, and I'm triple vaccinated. I don't have opposing views of society. I just hate how things were handled, where one day you're told one thing and you go to to contribute, and then the next day it's open season, everything's, you're good, go ahead. So those mixed messages sent business owners and the economy in a tailspin, meaning they don't know if to invest in chairs outside and spend $100,000 on a renovation or to continue on. And then, of course, on top of all this, you have money has to come back to normal. If you look at our rates today, are they high? I don't know. In 2007, when I bought my first home and my mortgage interest rate was 5.35, I thought I robbed the bank. So I don't know. But I also bought a house for $350,000 in Scarborough, not for $1.2 million. So I guess we won't know, well, if it was the same or is it different. So different environments call for different interpretations. Coming out of this pandemic, the banks and the government have to make up for what happened. So for better or for worse, whether we like Ottawa or we want to see a change, it's not going to be that much different no matter what colors you believe in, because the money's been printed, the money's out.
Well, and we've seen what happened in the United Kingdom, where Liz Truss, had the shortest prime ministership in history, because she tried to decide to run the economy differently than the current environment allows. Go supply side economics, compensate people for some of the challenges that the pandemic created. And the markets disciplined her so dramatically, she was out in 45 days. The British pound sunk to the lowest level ever. The financial marketplace was down, et cetera. So it may not, you may not like where we are, but the reality is internationally we have had an era of cheap money. Inflation is high, not just because of cheap money, but because of supply chain issues, because of the war in Ukraine, etc., because of the pandemic that caused so many
100%.
issues, and central governments worldwide are raising interest rates to bring inflation down, and Liz Truss tried to compete that.
Yeah.
It didn't work.
So Brian, if these are the facts, if these are the playing, if this is a game and we understand how we got to this game, or have a decent understanding of how we got to this game, and we understand what the rules are, so we know right now that we are, again, the very first generation in the history of this blessed country to see interest rise this fast in such a period of time. So the velocity of interest rate increases are actually meant to stop you from spending a dollar anywhere in order to collect the dollars off the street. That is what the financial policy today is. When somebody asks me, if the government knows that inflation is hitting and going to the grocery store costs double, why are they penalizing us with this monetary policy? And it's a good question if you don't understand economics, and that's okay. But to understand how a double negative impacts or creates a positive groundwork for the future is they're trying to curb your spending. They don't want consumer loans. They don't want you to renovate. They don't want you to spend any more money. They want your money off the street into your savings account. They're not doing it for the banks to make money. They're doing it to curb spending. By curbing spending and money coming off the street, your dollar will be worth more. So with inflation coming down, instead of needing $300 to buy groceries for the week for your family, you're going to need hopefully $270. That $30 spread is returning back into the power of the dollar. So ultra-inflationary times, if you want to kind of use a metric, look at the foreign exchange rate. Look at the value of your dollar against the American dollar, the pound, or whatever the case may be, and you'll see devaluation. And that's what they're trying to curb. Again, whether we like it, don't like it, believe in it or not, that is our economic policy. And that is the fundamental ground rule, which we'll get into how to use now these rules to win.
Okay, so if they're trying to stop us from purchasing, and the real estate market, as you have described, went up by 60, 70% in the last couple of years, doesn't that double up the reasons why the real estate market is going to come down? And if the real estate market's going to come down, how the heck can you win?
So this is a great question, and I guess let's get into it. So I'm going to speak to your audience. You are in the GTA. You're out of Mississauga. By fortune, I'm down the street from you. I'm in Mississauga as well. So let's take a look now. Let's say any one of us is sitting on $100,000. Any one of us, and we are thinking to invest in real estate. And you're gonna go to the cocktail party. Somebody's gonna say, "Don't do that. The real estate's gonna fall by another 10%. Don't invest in real estate. It's gonna come down." My question to anybody who says that is, okay, why? Why is it going to come down, and how? If somebody can tell me how, I will be forever grateful. Because in this country, in this region, now we'll speak to the macro Southern Ontario market. The ground rules that we are playing with are as follows. We are the economic engine of this country, period. It's not for debate. It's not for talking, this is better than Vancouver or all the things that people like to talk about, only because I'm in the business. Toronto is the economic capital and engine of this country, period. Mississauga has more Fortune 500 companies. Markham has more Fortune 500 companies blessing its streets than any other city on the planet, including Asia, Europe, anywhere. Mississauga and Markham, that Pearson Airport corridor, the tech corridor in Markham, downtown Bay Street in Toronto, have the most robust economy in North America. We have the population. We have the development and growth trajectory with 400,000 new immigrants landing in the country annually. So if we know as a fact that 6 months ago, before the interest rate changes, we were in the most heated real estate market in history, which was fueled by real growth, by real development, government after the re-election. We had a positive trajectory for cutting red tape around development. We can speak to that. But after this environment of positive was white hot. 1.5 million homes short, 1.8 million homes short is what Ontario is at today in order to bring affordability and balance to the market. So the only reason we are actually speaking to a declining market is an artificial element of interest rates that is meant to do something specific for a specific amount of time. Because for the last 40 years, this market, on average, has gone up by 7%. Not 5 years, not 10 years, not between 06 to 09, and the last 40 years. If anyone has any doubt to what is being said here today, simply Google it. Go to the Canada Mortgage Housing Corporation, visit the Toronto Real Estate Board, any entity where you feel you can verify and or fact check the things that we're mentioning today. So a 7% growth trajectory over 40 years. And if you look at the last 5 years, the last 10 years, it's much higher. The last 40 years includes the worst years in this province's real estate history, which was the mid-70s and the late 80s and early 90s.
And how much did they go down at that time?
Again, 15, 20, 30% in some cases, 40% in some micro markets, where people actually did walk away from their homes. They handed their keys and walked away. They had no choice.
And you don't think that's going to happen now? Not going to happen again for the reasons you've identified?
Not even close. So Ontario in 1990 and Ontario today are two different. They're not even in the same, not the same book. They're in a different library.
We got to take a break, but we're going to come back and continue this conversation in just 2 minutes with Simeon Papailias of REC Canada. Fascinating conversation. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking real estate and investing in real estate to win during a time of recession. Simeon Papailias is my guest. He's from REC Canada Real Estate Center. It's a brokerage investment firm in the real estate, focused on the real estate business. He is of the opinion that the real estate market goes up over time by about 7%, that there's a bunch of issues that we've got, fundamentals in the Greater Toronto Area. We're the economic engine. We've got 1.8 million houses short from what CMHC says we need to have to reach any level of reasonable affordability, and that long-term he thinks that the real estate market is a great place to invest, particularly given that you can leverage it. Let me challenge you a little bit here,
Sure.
Simeon, if I could.
Yes, please.
So the Ford government just last week, as you're undoubtedly aware, came out with a whole bunch of recommendations to increase supply, and said that one of the challenges we've got, and as you've correctly pointed out, CMHC says we need not 1.8 million homes, but 1.8 million homes in addition to what was otherwise going to be built. So the real shortage is far greater than that. And they said the problem, even given this massive, influx of money into the real estate market because of all the issues that you identified over the last couple of years with low interest rates, is really municipal governments, that we just haven't been approving enough product. And it's red tape, and it's NIMBYism, and it's lack of zoning flexibility. And some of the proposals they've made are pretty wide ranging, where, every homeowner as of right can increase the number of units within their home. So granny suites, basement apartments, things like that will be things that people will be able to do. That is going to be easier and faster for people to get development permits, building permits, etc., or zoning changes. That it's going to be more difficult to object to proposals in front of the Ontario Land Tribunal. bottom line, what they're going to do is they're going to increase the supply, or they're going to try to increase supply. And they're making mayors stronger if those mayors need extra powers to override councils, which I guess the provincial government is saying have failed in their responsibility to approve development. If you've got a increase in supply, if you've got increases in cost because of interest rates going up, and you've got the risk of prices going down because of all these factors we've talked about, my gosh, that's a pretty challenging investment environment, isn't it?
It is not. It is an environment that is not challenging, but it's an environment that needs strategic planning and execution. It is not as easy, meaning, no, you cannot buy a house now and it's worth $200,000 for no reason next year, because that's not investing. That's gambling and speculation. P.S. That's what was happening the last 5 years.
Gambling and speculation.
So the difference between investing, because let's take what you just said. It is the most time-proven, most amazing, and the sure way that you will never lose. And that one you can quote me on, because I've done it 1,000 times for both myself and my client. So if anybody in this audience wants to take the challenge and truly invest in real estate, let's talk about taking a single family home in an urban market, any urban market in the GTA. Identify the property, do the due diligence, buy it for the appropriate price, meaning not what somebody's asking. That's not market price. Market price is what I'm willing to pay for it, based on the current interest environment, based on what renovations, changes, what I'm going to make. Do I need to run a financial pro forma? Do I need to interview 3 contractors? Do I need to speak to a city inspector and a planner? Right now, we're on the rise of electric vehicles. If I'm going to take a single detached home and turn it into 3, a triplex, Brian, not only am I going to win, I'm going to walk away with $1 million, and let me tell you how right now. Let's buy any single detached, any market. We're in the GTA, so let's not be naive. We're not looking to appease people from anywhere else. It's $1 million. That's our market, correct?
Yep.
It's $1 million. Let's use that number. Let's try to be as real as possible. So I need 200K to put down. By hook or by crook, I have 200K. I make the acquisition. I have my closing costs. I'm sitting at 1 point, call it 1.1. If I have to rent that unit today with today's interest rates, I need to rent it for $6-7 grand to carry. Because on an $800,000 mortgage at X price, what is the payment? It's this much. Do you not agree that rents have gone up? Not do you not agree? Rents factually have gone up 30-35% in the last 8 months to a year.
Why?
Rates are up, rents are up.
Why?
The minute that you wipe out 80% of the buyer pool and they all have to go rent, now you have a surge in multiple offers and rental.
Right. I think this is an issue that a lot of people don't understand. I want you to explain it. What's happened is volume of purchases have gone down, overbidding and multiple bids and stuff like that have gone down. And so therefore people still have to live somewhere. And if they're not buying, they're going to rent, which means that we did have a year ago an oversupply of people trying to buy property. Today, people have backed off and aren't buying property, but they still got to live somewhere. And so that means we've got an oversupply,
commodity factor.
Over demand of renters.
Factor. The commodity factor, my friends. So if I have property, which I do, I am a housing provider. So if I bought property in 2015, forget about how much I paid for it. We know what it's worth today, so that's great. But if I don't sell it, I don't win, so it doesn't matter. I'm up on monopoly money. I'm up on paper. But what the reality is, the rent in 2015 were $1,500 for a 3-bedroom upstairs of a single-family home. Right now, they're at $3,200. Can you fathom? If I cash flowed in 2015 at $1,500, am I winning right now? And the answer is these types of environments are investor rejoice. You're not doing it at the expense of anyone. This is the market and the government and all the things. I'm not taking advantage or doing anything to feel bad about. I am simply participating in a market that is driven by demand with what we know factually a massive supply crisis. And it will be this way for another decade at the very least. Guaranteed, not maybe. We need 75,000 homes a year. We're building 25,000. I guess I'm in the right business from an investor standpoint. Let's go back to the triplex, please, Brian. Please. Because if I need to rent that house at $7,000, even if I were to get it, what have I serviced? What have I done to my fellow neighbor? Create another unaffordable home? Provide home to a wealthy businessman and his family? An executive couple? How did I resolve or contribute to society? I didn't. But if I were to not have to deal with a 2-year rezoning, because as of right, I can, and all I have to do is present my architectural plans, make sure it's up to code, and I can build a beautiful triplex in the neighborhood. I just created 3 1,000 square foot apartments that I can rent out for $3,000 a pop, $4,000 a pop, 2,000, 1,500, depends on what you build. Build a bunch of studios or whatever the case may be. But you have now contributed the solution to the problem. You are participating in resolving and giving more people the opportunity to enjoy Mississauga, Markham, Toronto, the park, the waterfront. You're not sending them to purgatory 80 kilometers west, east, or north, because their job is here. Putting somebody on a GO train for 2 hours or 3 hours a day, if they could avoid it, you don't think they would?
Your friends in Brantford and Aurelia are going to hate that you refer to them as purgatory, but okay, I got your point.
No, it's purgatory when you work downtown Toronto. Brantford is a blessed place on earth. But if you got to take a GO train an hour and a half each way, you'll see how quickly it defines purgatory. Because then you get to see your kids at 7 p.m. for 1 hour before they go to bed, instead of seeing them at 5:30 and enjoying the whole evening together. And this is people's reality every day because they have to drive to qualify. And it's because of the NIMBYism, because when I put an application on my beautiful street that I live in here in Mississauga, if I were to make an application to change to multifamily housing, I can tell you that 80% of the neighbors would be up in arms at rezoning and shooting down my application. Why? Because our street is beautiful and it has mature trees, and it does not belong to have 6 people living in one home or 9 people living in one home.
So do you think the provincial government is wrong in making these changes?
I think the provincial government, I think this is the only godsend that will ever change this. This climate needs supply. It's holding the key in its hand. And should this go through, I'm the absolute biggest proponent of inclusionary zoning, which means this is not for every neighborhood, guy. This is simply, if you're within 500 meters of a subway station, you have the right to change over. If you're on the transit line, if you are beside this zone to this zone, nobody's looking to create apartment buildings in a 5 million Streetsville or on Mississauga Road. There's no point. The people who would be renting there don't have any reason to be there. The infrastructure isn't there. We're talking about leveraging existing infrastructure for the benefit of all. If you're living on Highway 10 in Mississauga, where we're putting a brand new rail system, I know as a fact how many applications have gone in. We're looking at 10,000 doors over the next 10 years are going up in towers on Highway 10. Tomorrow, if you were to go for a walk down Highway 10 or for a drive down Highway 10, here Ontario Street, you're going to see application after application that they're going in to put high-rise up. Why? Because they're on the highway in 2 seconds. They're beside every single employment node, right beside the airport, right on an LRT line that's coming to service them, Why wouldn't somebody live there? If I can be to square one in 2 minutes, if I can be at the airport in 15, if I can hop on the highway and go to my job in 8 minutes flat. This is where it needs to change. And it shouldn't take 7 and 10 years for these applications to go through. We shouldn't have to pay $1,300 a square foot for a condominium at square one. It's insane. But that's the demand. So this is how you solve the problem or contribute to it. And I hope everyone takes the time to see both the opportunity in it, because if you have 3 doors at $3,000, you're no longer making $7,000 a month in your single family home. Now you're making $9,000. You're replacing income. You're creating wealth. And you do it enough times, you're creating generational wealth for you and your family, while providing housing and being a solution to society and helping society grow.
Our guest tonight, Simeon Papailias, REC Real Estate Center. Fascinating conversation. We're going to take a final break and come back with some concluding comments in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. Having a really interesting conversation tonight with Simeon Papailias, REC Real Estate Center, a brokerage entity and investment real estate firm specializing in the GTA. Simeon, I've really been interested in your comments about how you think that the supply needs to increase, the supply of housing needs to increase, and a very impassioned pitch that you gave us that the things that the provincial government are doing to make it easier to increase supply, both from a single family home converting to a triplex, but also to shorten the time period of approval of condominiums and other developments on major arterial roads and around transit nodes makes a ton of sense. And I agree with that. You know, when I think about what you've pitched us about today, about real estate as a good market long term, that interest rates are going up, and so therefore there could be some dislocation in the short term, but long term it's going to be people got to live, and immigrants are going to come, and we're the economic engine. I guess I simplify it down, and I want to see if you agree with this, that the last couple of years you could invest in real estate if you were a speculator and make money.
Yeah.
But what you're saying, I think, is that you're still going to be able to invest in real estate, but you got to be an investor. You got to think through the right price, not just buy. You got to think through the renovations and the investments that you got to make, and you probably got to rent it out. And think about how you're going to make money to pay back that mortgage, which is what investment is all about. And that, when the market's going up 70% in 3 years, you don't have to think through all that. You just sort of buy and speculate, and you make money no matter what. So are we going from real estate being a speculation to real estate being an investment?
I will answer your question, and it's a little bit dangerous. I think the market here is not only safe, it's so safe, and the supply crisis is so bad. It's so bad that even the speculators are going to continue to win, unfortunately, because speculators, for me personally, I'm very bothered. I don't like them. They hurt people. They hurt the market. But in a rising tide, all boats are safe, right? So that's what happened. And now that we just saw a little tinge where the interest rates went up and people got shook, you see people scrambling to find safe harbor. That's not investing. Because I'm not scared, I'm not shook. The fundamentals of my portfolio are so strong that I'm actually going to grow. My portfolio is growing through the recession because market rents have skyrocketed. So the advice here is 100% to heed, respect, and caution into your own hard-earned money. If you're going to place $50, $100, $200,000, we're not talking about chump change here. This is a market not for the weak. This isn't $175,000 home somewhere in Ohio. This is the market. This is a global market, $1 million entry. Respect your decision. Assemble a team of experts, a great and experienced, not a lawyer, a great real estate lawyer, not an accountant, a real estate accountant, not a realtor, but an investment-focused realtor, not a mortgage broker, but an investment-focused mortgage broker. Why? Because they have solution. They have different product suite. Meaning, if you walk into any of the big 6 banks and you ask for a mortgage, you're going to get one, but you're going to get theirs. If you say, I need to buy and renovate, you're going to get a different product. It's going to have a higher interest rate, but it's going to be inclusive of the renovation on an as if completed basis. So you may have to put less money down, bringing your risk down. This is not something that any person, if you are a school teacher and 10 hours a day, you're focused on the growth of those beautiful minds in your classroom, there is no way you can compete with me, who is a 10-hour-a-day real estate investor. So you need to get on a level playing field by hiring and assembling a team that can guide you through it. Because you can win like me. You can win like the myriads of investors who are winning right now. You need to know the tools and strategies that are available to you. And most people do not. That is my advice. There is at least 4 asset classes to make this happen, which is pre-construction, which is income properties, like we just discussed. There's so many, but this is how it's done.
Simeon, if people want to contact you to avail themselves of your services, how do they best do that?
They can visit reccanada.com. That's reccanada.com. But I'm on all social platforms: LinkedIn, Instagram. Papailias is my handle. Shoot me a message, and the team will reach out.
Simeon Papailias, thank you so much for joining us. I really appreciate it. You know, I do think that Simeon's got a lot of really important suggestions about assembling a team and thinking this through, because it is, I think, a real challenge that we have here in Toronto and the Southern Ontario, Greater Toronto area, in regards to lack of supply and huge amount of demand, with some potential short-term dislocation because of the increase in interest rates. And I guess he didn't accept my proposition, but I do think that it's going to be far more difficult to make money speculating. But if you're investing, and you're investing wisely, you're going to make good money in bad times and in good times. And the vast majority of people that have made a lot of wealth have actually made those investment decisions during tough times. When everyone's buying, it's easier to jump on the bandwagon and buy. What is difficult is when a whole bunch of people are selling and people don't know how far it's going to go down. It's very challenging to be the contrarian and make the investment. But that's actually what you should be trying to do, is buy low and sell high, rather than buy when everyone else is buying. And it's difficult. It's contrarian. It's challenging. At times it can be scary, but it's how you actually make money. At least I think so. Anyway, that's our show for tonight, everybody. Thanks for joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. Simeon Papailias, reccanada.com. Thank you so much for joining us.
Thank you for having me. I appreciate, and good evening.